everyone, and welcome back to SALT Talks. My name is John Darcy. I'm a partner at Skybridge Capital and the managing director of SALT, which is a global thought leadership forum and networking platform at the intersection of finance, technology, and public policy. SALT Talks is a digital interview series with leading investors, creators, and thinkers. And our goal on these talks is the same as our goal at our SALT conferences, the next of which is coming up next week in early March in Abu Dhabi, in partnership with key stakeholders there in the UAE, which we're very excited about. But our goal at those events and our goal on these SALT Talks is to provide a window into the mind of subject matter experts, as well as provide a platform for what we think are big ideas that are shaping the future. And with that, I'll turn it over to my partner, Dan Burrill, to begin today's interview.
Hi, everybody. Welcome back to SALT Talks. My name is Dan Burrill. I'm a partner on the investment team here at Skybridge Capital. Today, we are excited to interview two members of the executive team at Meridian Capital, San Francisco-based alternative credit manager. Notably, the firm's income fund won the HedgeWeek US Award for Best Credit Multi-Strategy Manager in 2022. So congratulations there. I'm going to pass it on to Don Davis, who's CEO and portfolio manager, and then Sean Bill, who's chief investment officer, to talk a bit more about their personal backgrounds and how Prime Meridian came together, and then we're going to really dig into the firm and its investment strategies.
Yeah, thanks, Dan. I'm Don Davis, founder and CEO of Prime Meridian Capital, and I've been in the industry for a little over 24 years. Previously started Novus Investments in 2004, and that was a firm where we were an IB and a CTA. We focused on credit, currencies, metals, in the futures markets, in the global futures markets, and we had some degree of success in doing so. It was a more high volatility, higher risk strategy. We were ranked number one in the U.S. A few times, twice over a 5-year period, once over a 7-year period for total return. We were getting a lot of demand over time for low vol sort of alternative credit strategies and alternative income. So it was something we were exploring quite significantly beginning in 2006, 2007. We became aware of this burgeoning sort of peer-to-peer marketplace lending space at the time. In fact, my partner, Val Kakiev out of New York, he was one of the very first lender investors at Prosper.com in March of 2006. And he built up, he was also the largest individual investor there for 7 consecutive years. And so we have some experience and data points with that. Going through the 2008 recession, we were shocked to see that account was up 0.5%, while the S&P was down 56 and everything else was torched. And so that was a good data point that we had on at least that portion of the industry. And then a few years later, the unthinkable happened. MF Global, the largest futures clearing firm in the world, had been around since 1783, had suddenly gone bankrupt. Investors eventually got all their money back, but it took a few years. And so that kind of sped up our decision to really pivot and make a move into the alternative private credit space. And we started off, and back then there were a lot of issues too with in the industry. There wasn't any bankruptcy, remote segregation of assets. It was a mess, and I was already a very risk averse guy, and I became even much more sensitive to systemic risk after the MF Global collapse. Of course, what we saw in 2008 with Bear Stearns and Lehman, all of that just led to to an increase in risk aversion on my part. And so eventually they tightened things up in the industry and they had bankruptcy, remote segregation of assets with backup servicers in place. And that's when we felt comfortable in early 2012 starting the first fund, Prime Meridian Income Fund. And we began in the peer-to-peer marketplace lending space as a foray into alternative private credit. But the intention all along was really to build a family of a few different funds covering all the verticals under the private credit space. And since then, we've won several notable awards. You mentioned a couple of them. Thank you for that. We were also voted the top fund manager by Lendit FinTech Conference, which is the industry's largest conference. And that was a panel of 40 judges and industry CEOs. And they chose Prime Meridian top fund manager for performance, experience, and contributions to the industry. And then the few awards that we won last year as well, which were pretty notable.
Very cool. Sean, a bit on your background and how you and Don came together.
Yeah, so it's kind of interesting. I started out at the Chicago Board of Trade in 1994 on the floor of the corn, wheat, soybean floor. So Don and I have a little similar history in the commodity markets, and kind of think and approach markets from a similar fashion and how we think about risk and what have you. I then went out to SoCal, went back to Southern California, joined a fixed income manager, was part of a team that grew that from 800 million to 10 billion. Then spun out of there, started a hedge fund that was seeded by PAMCO with a partner from PIMCO, and did that for the next 10 years roughly. And so we grew that business, and 2010, 2011 with zero interest rates and quantitative easing, global relative value trades kind of started to go away. The Polish 5-year forward versus the Euro 5-year forward spread went from 65 basis points down to zero. Right, they just all kind of collapsed on top of each other. So we ended up winding down, and I was looking at doing a short retirement. So we came back up to the Bay Area. My wife and I are both from the Bay Area, so we left Newport Beach and came back up here, bought a house, renovated, blah blah blah. And I decided I'd go back to Stanford Business School and study innovation and kind of refresh, myself. And then just very coincidentally, a classmate from high school, who was later the mayor of San Jose, Sam Liccardo, said, hey, we were having some issues with our pension funds and we could use some outside investment expertise. And so he's like, could you help us out on this? And I became a trustee for the city of San Jose's pension for $1 a year. And then I became the CIO of Santa Clara's pension. And then another classmate, Bill Coker, was the CIO of San Francisco's pension. And he asked me if I could help him out with the San Francisco pension. I sat on their hedge fund selection committee and was a senior advisor to the CIO's office and the board of administration. After about 10 years, I was nominated to the CIO magazine Power 100 list. And I thought to myself, that's a good time to ring the bell and move on. And so try to go out on top. And so I rang the bell. I was going to do another mini retirement and kind of had a spontaneous collision with Don. And, Don and I actually are 4 houses away from each other. And so while we had known each other over the years and had bumped into each other at fintech conferences, and I was investing on the equity side, Don's investing on the credit side, the debt side. So we knew of each other and had bumped into each other repeatedly since probably 2014. And it just was pretty random, kind of a serendipitous event that, Don said, hey, I'm looking for a CIO and would love to have a partner to work with. And so we decided, to give it a shot here. And I joined Prime Meridian at the beginning of 2022.
That's great. It's just not meant to be for you to retire, Sean. It's not meant to be. Not going to happen.
My wife's like, hey, how much longer?
Oh no, this is great, guys. So let's talk a bit. Let's get a bit into the strategies, right? And what is, to use hedge fund jargon, like what is the alpha proposition of Prime Meridian, right? So one, maybe high level, define what you guys do and the different strategies. And then, what do you think your edge is? What makes the firm special?
Well, maybe I'll jump in real quick here. So we have 4 funds. We have an income fund, which is like the name implies, it's about contractual income, monthly or quarterly pay, that type of stuff. We have a special opportunities fund, which is really kind of opportunistic, as the name implies, and really going for uncorrelated investments. And there we do stuff like litigation finance, life settlements, specialty credit, things like that. They're very uncorrelated to other sectors in the markets. Then we have our real estate fund, which is a senior secured lending against assets. And so there we'll do, single family, multifamily, and residential and commercial. And then we have a new fund strategy that we launched called the non-performing loan strategy, which is, as the name implies, is distress, where we're looking for opportunities in defaulted loans. And that one just crossed its first year of performance there. Don, I'll hand off to you. In terms of our edge, I think there's a couple different ones, and let Don start.
Yeah, and one differentiating factor is that, all of the funds are unlevered. Today's day and age, everybody wants to use leverage to kind of juice up the return, makes marketing easier. It's the easiest thing for anybody to do. It doesn't take any discipline, intelligence, or risk management, or education to use leverage and increase risk. It actually takes a tremendous amount of discipline to not do that and not get tempted by that lure. And that's exactly what we've done. So sometimes the returns are not sexy. We focus on, high single-digit net returns with very low risk. And that's been primarily in a zero interest rate, low interest rate environment for the past 10 years. So if the next 5 to 10 years are higher interest rate environment, if that were the case, we should expect to see our average annual returns materially increase, accordingly. But in either case, really my number one objective is to have the highest Sharpe ratio that we can have, to have the best risk adjusted returns that money can buy. And that's our number one focus.
Yeah, I'd add, Harry Markowitz, famously said there's diversification is the only free lunch in economics, right? And that I think is one of our strengths. We are highly diversified across our funds. So, not only just at the lending vertical, where maybe we're doing consumer, we're doing small business, we're doing real assets, finance, equipment finance, specialty finance, credit facilities, et cetera. But even within those verticals, so if you look at a consumer bucket for us, we may have 3,000, 4,000 loans in a portfolio, and that creates, it's kind of like I like to use the analogy of the Tempur-Pedic mattress. It's like you can have that glass of wine on there and you can take a sledgehammer onto the mattress and the wine doesn't move, right? You do get a lump over there. And, you do take a hit, but overall, it's a pretty damn stable, vehicle, the way we try to construct the portfolios. And that's been, I think, one of our secret sauces,
I've never heard that used, the Tempur-Pedic mattress, in an investment context. And I've talked to a lot of, investment managers. Like that.
Me neither.
Yeah, Rick Reeder and I were talking about that, and we were kind of talking about, what is the analogy? It's like a Tempur-Pedic mattress.
All right, so now if I hear him use it, I know he took it from you, Sean. There you go.
It might be the other way.
It's just sticking with the funds for a moment. What does the investor base look like at the firm? Is this, is it an institutional investor base, institutional and high net worth? What is kind of, how, if folks are interested in the products, how do they learn more, that kind of thing?
Yeah, historically, it's been family offices, multifamily office, asset management firms globally. We've had a couple of large institutions that we've worked with as well, and we're trying to get more involved in we're actually working on getting more institutional allocation and exposure.
That was one of the things that was very exciting for me about, the firm is, so coming from the pension world, you're looking, the funds that you're showing are going to be, the very big players, the Blackstones, the PIMCOs, what have you, right? And they're going to be trafficking in kind of middle market, direct lending, very competitive space, sponsor-based lending, et cetera. What's very different about Prime Meridian and what I thought was very attractive about it is I see like a Blackstone or PIMCO as an oil tanker. And I see us as like a little speedboat, we kind of buttress those other portfolios. We're doing kind of niche-y, off the run stuff that those guys, it would be too small for them to really get involved in, right? They want, the $50, $100 million EBITDA. We're looking for the $10 million EBITDA, $25 million EBITDA company to finance. So very different type of niche.
Yeah. And I think that's an excellent point, Sean, right? Because, I think you guys are around 250 million or so in AUM right now, right? And so, when you think about some of the other players in credit markets broadly, right? I mean, you just got some gigantic players, right? And it's, they can say that they are opportunistic and they move things around. It's hard, right? As you manage more and more capital, right? So 250 is a size where you can be really nimble.
They can do a single trade, on a real estate finance deal for 250. Whereas, we'll have 3,000 plus loans in there. If you look at our real estate fund, it'd be 300 plus loans, so very diversified, book of business. And we also, we kind of being a smaller manager that's very, I always like to kind of say that we try to think like an entrepreneur with institutional resources. We're based here in the Silicon Valley. We're exposed to a lot of innovation. our backgrounds, Don's background, my background, we come out of the fintech world in terms of investments, right? Me and Angel investing on the equity side, Don on the lending side. And so we do like to try to be kind of early and kind of think of ourselves as guys that are trying to finance the future, right? And so we've done credit facilities with companies where 3 years later, 4 years later, a company like Ares will discover them, and they'll do a credit facility that's much bigger. But we get in there before they get in there, and we're able to capture what I'd say is a little excess complexity premium because people don't understand it. And by the time they do understand it, we're moving on to the next one. So, I think that's one of the other things that really gives us an advantage against our peers.
Very cool. All right, so let's talk a bit about just the overall market backdrop. So it's been an interesting several years here, right? So we can, we'll just go back a few years to kind of the beginning of the pandemic, and maybe, talk about how, your various strategies were impacted by that shock in credit markets, which really was, if you were involved in these markets at the time, as we were here at Skybridge, right? I mean, you had exceptional moves in these markets, this gapping kind of price action that happened over the course of a couple of days, in some cases that more extreme than 2008, right? And talk about how that impacted, your portfolios short term, but then also how that created opportunities over the course of 2020, 21. Obviously, the current rate hiking cycle, which is not over, is one of the biggest debates out there. When is it going to be over, right? How much wood is there left to chop, right? And so talk about how the hiking environment has impacted the funds. And then maybe we tie that together to just, what's the outlook? What's the firm kind of outlook overall from a macro perspective, and specifically credit markets, right? Because, spreads are still pretty tight, right?
Very tight.
I saw a chart the other day. I double checked it. I didn't believe it. It was a Goldman Sachs chart that they put out on IG, short-term IG, and there's like zero spread, like no spread, right?
Yeah.
And now you've got, high yield is like,
875-ish.
You're not getting paid for the risk you're taking, I don't think, where we are in the cycle. I don't think. You guys are in some more off-the-run markets, right? So kind of talk about what value looks like there, what you're nervous about given this uncertain environment. I know that's a lot, but
Yeah, why don't you jump in, Don, and then I'll fill in.
Yeah, I'll start off with the backdrop on the pandemic. So when that first hit, and first off, we use a discount cash flow valuation methodology with a third-party valuation agent. That's an institutional gold standard for credit portfolios, but there's many funds out there that don't do that. Even funds quite a bit larger than us. So in the month of March 2020. The valuation agents and all of our funds did a macro valuation adjustment. So there were no increase in delinquencies or defaults yet at that time, but they looked forward and said 6 months from now, things look a lot more bleak than they did the prior 6 months. So they haircutted the entire portfolios. And we had I think in our income fund, we were minus 1.8 for that 1 month. The other funds were still profitable, but they were just barely because of that adjustment. But then after that, the funds held up surprisingly well. The consumer market did very well. I think the stimulus and the transfer payments, some of the forbearance programs that were mandated by the feds, I think helped that. But our income fund, I think, finished in the nines net. So it had even a little bit better than average year in 2020. Our special ops fund did very well. Again, that's mostly non-correlated to the market. So life settlement, litigation finance, it behaves kind of independently to what goes on. And then the small business sector was the hardest hit. And even real estate bridge borrowers and fix and flip borrowers are technically small business, owners. Those were hit the hardest in the market. And we still finished up, profitable. I think we were up 6% or so in 2020 on the real estate fund. So, the funds were still profitable, but they were compressed due to increase in delinquencies and defaults. Now, fast forwarding a year or two, the courts were closed for the majority of 2 years, if you remember. So what happens in that case, there's no enforcement, right, on a defaulted small business loan or a real estate bridge loan. And because there's no enforcement, right, they kind of hang on the books a little bit longer. And we saw that. The other thing with litigation finance, never before in U.S. history have the courts been closed like that, to my knowledge, and I've looked back, I think, since 1870. And so for the first time in U.S. history, we've had the courts closed for the majority part of 2 years. And so even our litigation finance took some small haircuts, that portfolio, because, of course, as you know, IRR is a function of recovery and time. So the longer the time to recovery, it lowers the IRR. So generally, lit finance has no correlation at all unless the courts are closed. Then you'll get a little bit of a haircut. So we had some compression there, but overall, these funds remained very low volatility and profitable, and they were out of favor though. I'll say in 2021, in the entire calendar year of 2021, everybody wanted those quote guaranteed double-digit returns on tech stocks and crypto, right? And nobody wanted that boring, very low risk, high single-digit net return. Nobody wanted it. They thought it was too easy to get double-digit returns. So in 2022, by summer of 22, we started getting a lot more looks, a lot more love, a lot more respect, for the downside, protection and the low-risk nature of our funds. And now I think we're on a lot of big allocators' radars for 2023.
Very cool.
Yeah, I think when you look back to 2022, it's Martin Zweig, right, who coined the phrase in 1970, "Don't fight the Fed," right? And we had an 18x increase in interest rates here in 2022. It's the worst performance for long bonds since the 1700s. It's kind of crazy. If you look at the S&P down 18, the Barclays Ag down 13, we've had 5 years in history where both were down or negative for the year. The only years that were worse than this was 1932 and 1974. So a lot of our competitors that have longer duration portfolios that have more credit risk had a very tough, challenging period. You could look at pretty much any of the big names. I think what helped us was that our portfolios are pretty short duration by nature. We're generally not going beyond a 3-year loan. A lot of our consumer debt and stuff like that cash flows very quickly in terms of payoffs. So it kind of enabled us to kind of, I'd say, dodge a bullet on duration, where a lot of people got hit on duration and lost. Your Barclays Ag was down 13. We were actually able to stay positive and protect capital and grow assets in 2022. And I think short duration and the high yield of nature of our portfolio, we did start to see. There's a little lag, but we have seen where credit spreads have begun to widen. Stuff that we used to get 8% on, we can get 11 or 12 now in the real estate and real asset space. In the specialty credit area, where you might have gotten 12 in the past, you can now go, call it 15, 16. Another thing that really helped us in 2022 is that because we don't use leverage on the fund, we were in a very good position to take advantage of other funds that did have leverage, that did need to sell some securities to meet redemptions and what have you. And so we were able to buy some secondary paper, 1-year paper at a 14% yield, different names and stuff. That was kind of our general bucket. But we got gravel companies in Canada that face municipalities that aren't going away. You still got to put the gravel down when the winter ice thaws and get the roads back up. And we are lending to those types of folks with strong asset coverage. We got some clean energy plays that are really interesting in the fracking space to help those guys clean up a little bit. Again, 1-year paper in that 14% neighborhood, basically distressed sellers that need to get out and get some liquidity for their investors. So again, leverage cuts both ways. We definitely have gotten a lot of questions about leverage and people chasing returns. And I think one of the things that Don and I try to point out is these funds that have done 7 or 8% over the last decade are doing that in a zero interest rate environment. And we certainly would think that we will capture some of that spread increase in the future, and that the rates will and the returns will move up as well. So I think those are some of the takeaways from 2020 and the pandemic, and 2022 with the federal rate hikes.
Mm-hmm. And so a naturally short duration portfolio, obviously a good thing in 2022. Yeah. Anything is anything structured as floating rate in your book, Sean, or not typically?
Not typically. Typically, we write out fixed maturities. Generally speaking,
credit.
Yeah, a little bit in specialty credit, but I'd say 75% of the portfolios are going to be pretty fixed on that. The trying to think of like, I think, typically 1 year to call it 3 years, consumer stuff is all going to be pretty much fixed rate. The real estate loans that we do are usually fixed rate for a 12-month term. The specialty credit stuff where you get some floaters.
Got it. Okay. And so maybe, so last part of my, my long question, right? It's market outlook right now. So, high level, and then also as it relates to your portfolio, right? When we look into 2023, right? There's a lot of, uncertain environment, right? Fed's obviously not done. Inflation still has a 6 handle on it, but, unemployment stubbornly low, GDP growth continues, right? It's this interesting time we're in right now, right?
Yeah.
So what's kind of the house view for how the market evolves from here, and also how the rate hike cycle evolves? And where do you potentially see opportunities down the road?
You want to go first, Don, or?
Yeah, sure. We're seeing a lot of incredible opportunities in the specialty credit space right now. But even in our real estate bridge loan space, we're seeing, as Sean mentioned earlier, about 300 basis points higher for the exact same level of risk. So for the exact same borrower, literally about 12, 13 months ago, it's about a 300 basis point increase for a 12-month loan. So an 8 is now an 11, a 9 back then is now a 12. And in specialty credit, we're seeing a lot of stuff in 14, 15, range. And so litigation finance is always interesting. And so those are the areas where we're seeing, I think, the highest alpha relative to risk. Or
I think on the Fed. Well, I think like on the Fed and that stuff, we do think that the inflation is pretty sticky, and it's going to be higher for longer. In the past, I think that kind of the slogan was lower for longer with the Fed, and I think now it might be higher for longer. The retail sales number that came in this week, CPI numbers that came in, the employment numbers that came in, they're all quite strong. So I think that the Fed will probably, we wrote a letter last month. We said basically it's kind of like the Fed versus the capital markets, right? And the capital markets want the rates to come down so we can get things going in the equity space and growth investments again. And the Fed is like, geez, we got to choke off inflation, and they're going to try and keep rates high. And it's going to be really data. It's going to be driven around all the data. And I think in the last month, the data definitely says that the Fed is going to be sticky and stay higher longer. So now for us, that's a good thing because, short-term rates have moved up to 5% on a 1-year treasury bill. And so our investments that tend to be that 1 to 3 year bucket are seeing a nice improvement in the yields that we're capturing. So we're pretty positive there. I think we also have a pretty contrarian take on housing. We do feel like that the consumers the homeowners have a lot of equity. They have very low fixed rate mortgages locked in. And we don't think you're going to see a lot of supply in the market, come to the market from sellers looking to move, and that's going to keep this shortage of housing, will continue to be a problem and will be an underlying supporting factor in the market. So we're pretty positive. I think it's the second half of 2023 story there, and then we are looking at areas where there's blood in the streets and people don't want to approach it. So we've got a deal that we're looking at that is a data center for crypto miners. And rather than having direct exposure to crypto, we would be doing equipment finance deals for them. So we will be financing the transformers and the cabling and the substation, and we'll have 3-to-1 asset coverage on that stuff, and a lot of equity underneath us. And we're kind of trying to take that approach of, okay, nobody wants to touch it. Right. But we understand digital assets pretty well. We've been involved for a long time. And, we think here we can kind of participate through the picks and shovels, kind of take the Levi's approach. We don't have any direct exposure to the underlying, but we'll finance those transformers. We'll finance the stuff that they need to power the data centers.
Very cool. Okay. Maybe we take a step back and from macro back into kind of just, portfolio and how you guys build things. Right. So, take me through portfolio construction, how you put it together, right? So that's everything from, sourcing to, sizing, and then portfolio management as well, right? So, Don, Sean, I'm not sure who wants to take that one, but
sure. Yeah, I'll start off. We take a top-down approach first. So first, to identify objectives, create the investment policy statement, and then figure out how to get there, right? And so we've always looked at it. We have 23 different counterparties that we work with for assessing deal flow, accessing deal flow, picking and choosing loans. Sometimes we're a JV, sometimes we're a participant, on a facility, and sometimes we're the lead and only lender on a deal like the crypto data center that Sean just mentioned. So we're really agnostic to how we get it. That's all we care about, is really having the best risk-adjusted returns for our investors, whether that comes through a marketplace lender or buying directly from a bank or buying a distressed asset. It's really just how does it mix and fit in with our investment policy statement. We have a ton of risk limits and concentration limits built into that investment policy statement, everything from geographic concentration to concentration on loan type. So like in the real estate fund, for example, we have a single family, multifamily, and commercial, and we do a minimum of 25% in each category, a max of 50% in each category. For example, we also cap the exposure to no more than 1.25% of the entire portfolio for a single loan. And most of the time, it's even less than 0.5%. So that gives us lots of loans, as Sean mentioned, 300 loans in 40 different states. So we'll partner with fintech platforms and anybody and everybody, to really get the types of deal flow that we need. We have a credit modeling overlay. We have our own box that anything we look at kind of goes through for a pass or fail. In the early years, it was an API, sort of an arms race. They used to call it at Lending Club and Prosper, whoever had the fastest servers and API. And we were certainly among the top of their co-location. It was a game in the system, how to get in there first. And things have changed since then. But we really have a great reputation. We have very deep connections between Sean and I both. And so we really have access to a lot of different types of assets under the private credit umbrella. You want to add to that, Sean?
No, I think that really covers it pretty thoroughly. I mean, right. I think I'd say there's a couple layers. The first layer is the originators, and as Don mentioned, we really do try to be a good partner to the originators. So, we may be doing a credit facility with them. We may be buying loans off their platform. Or maybe doing a direct origination deal like the one that we just talked about in the power space. And so with the platforms, it's great because we get an initial filter, right? They may get 100 loans that come in, 100 loan applications. They may decide to process, 7 of them. And then we have our own filters on top of that. From what we can see, we've done 100,000 loans over the years, for about $1.8 billion in origination. And, we have a lot of data too. And so we can kind of see what has worked in the past, what hasn't worked in the past, and kind of adjust our buy boxes around that. And so we kind of get, kind of a double layer of what I would call tech-enabled investments, where we are really trying to be using the data analytics to our advantage. I'll give you an example. In the consumer space, one of our platforms that we work with talks a little bit about the default differentials between somebody that goes through an application with a mouse and the person that does the tab button. And the person that does the tab button tends to be a more savvy borrower who's a little more tech enabled and has a lower default rate.
Oh,
and so,
fascinating.
Wow. Little things like this, can kind of make a difference on the edges,
Wow.
and helps us as a lending fund, helps us capture that coupon longer, right? And increase the runway on that return by avoiding those maybe what are kind of borrowers you don't necessarily want to be lending to. So we have a lot of different tools that we can access through our partners and internal models that we have here.
And then once, generally speaking, across your portfolios, I think based on the strategy and given that these are generally short duration exposures, it's the risk management is really upfront, right, on the underwriting, and there's probably limited turnover in the portfolio. But do you guys ever sell anything? Do you ever hedge? Do you put on kind of market hedges, or talk through that a bit?
Yeah, we had one really interesting transaction we did a couple months ago. when the markets were just, really going sideways, we have a lot of investments that are really uncorrelated, right? And so people want those exposures. And so we took a small piece of our life settlements portfolio and put it out for the bid. And the bid came back very strong, much stronger than where we had been holding it, actually. And we were able to monetize that, sell a portion of that portfolio at what we would consider a pretty strong premium to where the market was valuing it at the time. And then we use those resources to redeploy to kind of take advantage of some of the distressed sellers in the secondary markets. So we can move the portfolio around a little bit. We don't move it a ton, but there are opportunities like that come up with the life settlements and other deals that you would think would be very less liquid, but they are so uncorrelated that there is a very strong demand for those products.
Very cool. All right, I think we've been going a little over half an hour or so now. So I guess guys, if we'll wrap it up shortly. But any closing comments you'd like to make about the firm or the current environment or whatever? Floor is yours.
Yeah. I mean, I think as I kind of started with at the beginning, one of the things that was very exciting to me about joining Prime Meridian is I do feel like the firm is very well positioned to help institutional investors with their private credit portfolios. Most of those investors have pretty generic exposure in the private credit markets with very large shops. And I think what really differentiates us from the competition is not only our size, but our kind of innovative nature or DNA, where we are trying to pursue markets that are less efficient, less well understood. They're smaller, and it creates a great alpha source, I think, for those investors. I think we're kind of an interesting play for the institutional crowd.
Very cool. Don, any closing remarks?
Yeah, I think that was very well said. We're very excited about 2023. I mean, there's certainly a lot of risks in the markets and in the world. There generally are. I mean, we have a war in Europe right now. We have a high inflationary, high interest rate environment. I do think there will be some accidents with some financial firms and investment funds out there in the next few months, because every time the Fed raises interest rates, there's blowups, somewhere. Even in the taper tantrum of 2018, there were some big blowups. The first big blowup has happened already. That's FTX. But there my educated guess is there's a couple more coming. It certainly won't be Prime Meridian. And we're really excited about this year. We think we're going to get some big allocations. We're going to perform very well, in my opinion.
All right, very cool. All right, Don Davis, Sean Bill, thanks so much for joining us for another Salt Talks. Take care, everybody.
Thank you, Dan.
Thanks for joining us.
Thank you, Dan, for hosting a great interview, and thank you to Sean and Don for joining us today on Salt Talks. Just a reminder, if you missed any part of this episode or any of our previous episodes, all of the episodes of Salt Talks are available on demand on our website at salt.org/talks. We're also on social media. Twitter is where we're most active at Salt Conference, but we're also on LinkedIn, Instagram, and Facebook as well. And please spread the word about these Salt Talks. It's always great to hear from great investors and portfolio managers like Sean and Don. But on behalf of Dan and the entire Salt team, this is John Darcy signing off from Salt Talks for today. We hope to see you back here again soon.